Okay, so welcome to another video. So today's video we're going to look at the weekly macro themes. So that's actually the paid subscription service that we're providing. Now there's a couple of reasons I wanted to have a look at this. First of all is to provide a little bit of insight into the types of things we're doing in the report. The other thing I wanted to do is perhaps show you just a little bit about maybe how to read the actual report and also just actually give you a bit of insights and value add. So let's start off, we're going to have a little look at the first theme in the most recent edition, and that's China monetary policy shift. So the first thing you'll note is in the bold there, that's what the title is, that's what the thing's about. The second thing that you probably want to go straight to is the bottom line. So that's the key conclusion. If there's any investment implications, it'll be in there. So today for this one, rising inflation appears to have prompted a shift in monetary policy in China. This will create risk for property, but also stem some of the currency devaluation pressure in the immediate term. So let's go through this. There's a series of charts to support that. It's pretty much a story around those charts. So the first one there, we can see this is quite a few different measures of inflation in China. So we've got the headline CPI, we've got core CPI measure there, ex food and energy, which interestingly enough has been fairly constant throughout that period, but noticeably has picked up recently. All those standard measures of inflation are starting to pick up. Perhaps more importantly, over onto that one, so you can see property price inflation and producer price inflation, massive turnaround there. And if we look at the past, whenever you've seen that before, you tend to see a pickup in interest rates, a response to that monetary policy-wise. And that's actually what we're starting to see there. If you look over at this chart here, you can see 10-year interest rate swaps starting to rise. The key sort of interbank lending rate there, the 1 month rate, starting to tick up. Now, with this 10-year rate here, I thought I'd sort of focus in on that one just very quickly. So if you look at this chart here, it's showing you monthly look at that particular interest rate. Notice that it's inverted, so higher rate is lower on the chart, and it's also pushed forward by about 12 months against property and price inflation. And so, you look at that chart and not knowing anything else, you start to think, well, is China headed for a property price downturn? And rather than just being fun with charts, it's probably quite meaningful, because whenever interest rates go up, that tends to make things harder for borrowing money. It means that the marginal buyer is not going to have as much purchasing power, and anyone who's sort of marginal financial situation and they start to see rising interest rates, it also puts pressure on them. So from that chart alone, it would tend to make sense to see a bit of risk to property prices, and that's of course the risk. If the People's Bank of China sees this and decides to tighten rates too aggressively, then you could actually see some of those property-related risks start to precipitate. I mean, my view is that we don't see this type of aggressive hiking cycle or that type, unless there's a real turnaround in the actual economics. It's probably going to be more of a not as passive as the stealth tightening that we saw around this period. Some of this, sort of stealth tightening that went on, as well as some of the macro potential tightening that went on in the property market, which helped drive that there a bit. So I think we're going to see a mild hiking cycle in China. We're already seeing it there, whether or not it actually flows through and into the official benchmark rate. So some of that is that inflation's starting to rise in China, and the policymakers are reacting as you probably would expect them to. And that's going to create potential risks for the property market if they do too much. Final chart where that might not cause so much issues, or where it might take some pressure off, is if you look at this chart here, shows relative interest rates against USD CNY. And strangely enough, for that exchange rate, much like just about any other exchange rate in the world, tends to follow what's happening with relative interest rates. And so if you start to see a little bit of upward pressure on Chinese interest rates, then that's going to tend to take some of the devaluation pressure out of that. Of course, there's two sides of the coin, and the Fed is the other side of that coin. And this week we actually get Fed monetary, the Fed meeting minutes, so that'll be something to watch out for. And that is about it. So if you have any questions, comments about that, put them in the comments below. And otherwise, if you want to receive a copy of this or get a trial, then by all means get in touch.